Forex trading is an exciting and dynamic market, but it's also filled with pitfalls that catch beginners and even intermediate traders off guard. In fact, a large majority of retail Forex traders end up losing money, often due to avoidable errors. Whether you're analyzing charts on TradingView or placing orders on MetaTrader 4/5, MT4/MT5, the principles of disciplined trading remain the same. Today, we'll explore how to avoid the most common Forex trading mistakes, from overleveraging to revenge trading, so you can trade smarter and more safely. By understanding these mistakes, the psychology behind them, and the strategies to avoid them, you'll be better equipped to navigate the Forex market with confidence. Let's dive in. One of the fastest ways to lose money in Forex is trading without a clear plan. A trading plan is like a roadmap. It defines when you enter a trade, why you enter, and how you'll exit. Without a plan, it's easy to get swept up by emotion and make impulsive decisions based on fear or excitement. Essentially, trading without a strategy is gambling rather than trading with purpose, leading to inconsistent results and costly mistakes. Why this is a problem? If you don't have a plan, you're likely to chase random setups and react emotionally to market moves. You might jump in or out of trades for the wrong reasons. For example, exiting at the first sign of a loss or holding on too long when a trade turns profitable, simply because you have no predefined rules. This inconsistency makes it impossible to measure what's working and what isn't. As the old saying goes, failing to plan is planning to fail. Without a strategy and rules, you're trading on hope and gut feelings, which rarely ends well. How to avoid it? Create a written trading plan. Document your trading strategy, including your setup criteria, entry/exit rules, and risk management rules, e.g. risk 1 to 2% of capital per trade. Writing it down makes it concrete. For instance, decide in advance that I will only trade when X and Y indicators align, and I will exit if price hits my stop or target. Set clear goals. Determine whether you're trading for short-term income or long-term growth. Having clear goals helps tailor your plan to your style. A day trader's plan will differ from a swing trader's. Use a demo account. Before risking real money, test your plan on a demo account in real market conditions. Platforms like MT4/MT5 or TradingView offer demo trading or paper trading features that let you practice without losing actual funds. This practice builds confidence in your strategy. Journal your trades. Keep a trading journal to record every trade. Note the reason for entry, exit, and the outcome. This is your personal trading diary and coach. By reviewing your journal, you can identify mistakes and successes, which helps refine your plan over time. For example, you might discover that trades taken outside your plan, impulsive trades, are the ones losing money. Remember, a trading plan and journal are like your Forex GPS. They keep you on track and prevent you from wandering into impulsive trades. As Dr. Pipslow of Baby Pips quips, you don't want to be like Frodo losing sight of his mission. Stay focused on your mission of consistent, planned trading. Even with a great strategy, poor risk management can ruin your trading account. Many beginners focus only on potential profits and forget to plan for losses, leaving themselves exposed when the market moves against them. Risk management is all about controlling how much you could lose on any given trade and protecting your capital from big drawdowns. Why this is a problem? Without defined risk limits, one bad trade can wipe out the gains from many winning trades. Improper risk management often leads to emotional decision-making. For example, panicking and closing a trade too late, or holding a losing position hoping it turns around, and taking a much bigger loss than planned. Traders who don't manage risk may also use positions that are too large for their account, which magnifies losses beyond what their balance can handle. Ignoring risk is like driving a car without brakes. Eventually, an abrupt stop is inevitable. How to avoid it? Never risk more than 1 to 2%. per trade. A cardinal rule is to limit the risk on each trade to a small percentage of your account, often 2% or less. This ensures that even a string of losses won't destroy your account. For example, with a $5,000 account, 2% risk means a maximum of $100 risk per trade. Sticking to this rule forces you to size positions appropriately. Use stop-loss orders. Always set a stop-loss at the time you enter a trade, at a price level where you'll exit if the trade goes wrong. This predefined cutoff point keeps a small loss from turning into a catastrophic one. Successful traders always use stop-losses. Some even use guaranteed stop-losses offered by brokers to be sure their stop will execute at a set level. The key is to define your maximum loss before you enter the trade. Maintain a good risk-to-reward ratio. Only take trades where the potential reward outweighs the risk. A common guideline is aiming for at least a 2-to-1 reward-to-risk ratio. For instance, if your stop loss is 50 pips away, target a profit of 100 pips or more. This way, you can be profitable overall even if only half your trades are winners. Position sizing and diversification. Calculate your position size based on the stop-loss distance and your 1 to 2% risk limit. Use a position size calculator. Many brokers and platforms provide this tool to get the correct lot size for each trade. Also, avoid putting all your capital in one trade or one currency pair. Spreading risk out can protect you if one position tanks. Keep records and evaluate. Track your trades and their outcomes relative to the risk taken. If you find yourself breaking your risk rules, figure out why. Sometimes emotions tempt us to risk more, especially after a big win or loss. Recognize those moments and stick to your plan. Discipline is what separates successful traders from the rest. Proper risk management might not be glamorous, but it's essential for long-term survival in Forex. Think of it as your safety harness in trading. It might feel restrictive at times, but it will save you from disastrous falls. Leverage allows Forex traders to control large positions with relatively small capital, but using too much leverage, overleveraging, is a common and deadly mistake. Brokers on platforms like MT4/MT5 often offer leverage ratios of 50-to-1, 100-to-1, or even 500-to-1, which can entice traders to take oversized positions. While leverage can amplify profits, it amplifies losses just as quickly, hence the term double-edged sword. Why this is a problem? Overleveraging means a tiny market move against you can cause huge losses. When your position size is too large for your account, a price swing of even 0.5% or 1% can trigger margin calls or wipe out your account. For example, at 500-to-1 leverage, a mere 0.2% adverse move, 20 pips on EURUSD, could wipe out your entire margin on a trade. Many beginners see high leverage as a shortcut to big profits, only to find that losses accumulate at lightning speed when trades go wrong. In short, excessive leverage gives you a fragile account that can't withstand normal market fluctuations. How to avoid it? Use reasonable position sizes. Just because high leverage is available doesn't mean you should max it out. Trade smaller lot sizes that align with your account size and risk tolerance. A good practice is to calculate position size based on the 1 to 2% risk rule, as discussed above. This inherently keeps leverage in check. Focus on effective leverage. Consider the ratio of your total open positions to your equity. Even if 100-to-1 leverage is offered, you might choose to effectively use only 5-to-1 or 10-to-1 on any trade. It's better to err on the side of lower leverage, especially as a beginner. This gives your trades more breathing room for the market to move normally without hitting your stop immediately. Always set stop losses. When using leverage, stop loss orders are non-negotiable. They cap the downside of an amplified position. Ensure your stop loss distance is reasonable relative to the leverage. If you're using high leverage, your stop might need to be tighter to protect your account. but tight stops can trigger easily. It's a balancing act, so generally it's wiser to reduce leverage and set a reasonable stop. Aim for consistent growth, not quick riches. Overleveraging is often driven by the greed for quick, big wins. Shift your mindset to seek steady, consistent returns rather than trying to hit the jackpot on one or two trades. Remember, slow and steady growth beats explosive gains followed by an explosive blow-up. Dash. Know the math. Take time to understand how margin and leverage work on your trading platform. For instance, using the position size calculator tool, available on many platforms and trading websites, can help you see how much leverage you're effectively using per trade. Being aware of the numbers will keep you honest about the risks. In summary, leverage is a powerful tool. Used responsibly, it unlocks opportunities. Used recklessly, it can drain your account overnight. Always respect the risk that comes with leverage. If you find yourself constantly on the edge of a margin call, it's a clear sign you need to dial back the leverage and risk. Trading without a stop loss is equivalent to cleaning the top floor windows of a skyscraper without a safety harness. It might go fine for a while, but eventually one slip can be catastrophic. Ignoring stop loss orders, or not using them at all, is a mistake that can cost you your entire account. Some traders also make the error of setting a stop loss, but then moving or removing it when the trade goes in the wrong direction, nullifying its purpose. Why this is a problem? No trader has a 100% win rate. Losses are part of the game. Without stop losses, a single bad trade can balloon into an account-wiping loss because there's no predefined exit. You might confidently believe you'll manually close a trade if it goes bad, but when you're actually in the situation, psychology takes over, denial and hope creep in. Traders without stops often let losers run, praying for a reversal, which only deepens the loss. Using stop losses is about survival. It ensures that even when you're wrong, you live to trade another day with only a small, manageable loss rather than a devastating one. Without that safety net, one fall, one big market move against you could knock you out of the game. How to avoid it? Always set a stop at trade entry. Make it a strict habit that every time you open a trade, you immediately place a stop loss order. In MT4/MT5, you can set the stop loss price in the order window itself. On TradingView or other platforms, use their trading interface or ask your broker's platform to attach a stop. By defining your uncle point up front, the price that proves your trade idea wrong, you prevent emotion from overruling logic later. Place stops at logical levels. A good stop loss is not arbitrary. It's placed at a price level that, if reached, indicates your trade setup failed. This could be just beyond a support/resistance level, technical indicator point, or a percentage of account. Avoid ridiculously tight stops that get hit by normal volatility, but also avoid stops so wide that you're risking too much. Find a balance and adjust your position size accordingly. Don't move stops on a losing trade. If your stop loss is hit, take the loss and move on. One common psychological trap is shifting your stop further out as price approaches it, rationalizing that just a bit more room and it will turn around. This usually just makes a small loss bigger. Stick to your original plan. It's better to be stopped out and reevaluate than to sabotage your risk management. Consider trailing stops for winners. While the main focus is protecting against losses, also plan how to protect profits. Many platforms allow trailing stop orders. These move your stop loss up as the trade moves in your favor, locking in gains. For example, if a trade is strongly profitable, you might trail your stop to break even, so you can't lose, and then further into profit as the price advances. This way, you won't give back all your hard-earned gains if the market reverses sharply. Use mental stops if needed. In fast-moving markets or certain strategies, like news trading or some scalping methods, you might not place a hard stop due to volatility. In such cases, you must have a mental stop. a firm price or condition where you'll exit no matter what. However, sticking to mental stops requires a lot of discipline. If you struggle with that, always use actual stop orders to enforce the discipline for you. Analogy. Think of a stop loss like the circuit breaker in your home's electrical system. It might be annoying when it trips, but it prevents a disaster, like an electrical fire. Similarly, a stop loss might take you out of a trade, but it prevents a much bigger burn to your account. Don't ignore that protective tool. It's there to save you from the what-if scenario of a trade gone bad. Do you ever see a currency pair making a big move and feel an irresistible urge to jump in right now so you don't miss out? That's chasing the market, fueled by FOMO, the fear of missing out. It happens when traders enter positions late, after prices have already moved significantly, just because they can't stand aside and watch the move without them. Unfortunately, by the time most people chase a trend, the momentum is often dying out or about to reverse. Why this is a problem? Chasing trades often means buying high or selling low, which is the opposite of profitable trading. When you enter after a large candle or extended run, your reward-to-risk ratio is poor. You're getting in near the tail end of the move. If the market reverses, which frequently happens after an overextended move, you end up trapped in an instant losing position. Chasing is also an emotional decision rather than a logical one. It indicates you're reacting to price instead of sticking to a strategy. This can lead to a cycle of bad entries and frustration. In essence, chasing the market is like running after a moving train, a dangerous endeavor that often ends in a fall. How to avoid it? Plan entries in advance. The best antidote to FOMO is having a plan, tying back to mistake number 1. Identify key price levels beforehand where you would enter a trade, for example, at a support or resistance level, or on a specific technical signal. By plotting these levels on your chart, you'll be less tempted to jump in at random. You'll act when your conditions are met, not just because the market is moving fast. Use price alerts. Rather than staring at the screen and feeling anxiety as price races away, set price alerts on your platform. TradingView, for instance, allows you to set an alert at a certain price. MT4/MT5 can also pop up alerts or notifications. If a pair has surged beyond your ideal entry, an alert can notify you when price retraces or reaches a level where you're comfortable entering. This way, you're waiting for the market to come to you. As the saying goes, let the trade come to you, don't chase it. Accept missing out as part of trading. It's important to mentally accept that you cannot catch every move, and that's okay. There will always be another opportunity. Remind yourself that sometimes the best trade is no trade. Sitting on your hands is a valid strategy when nothing aligns with your plan. The Forex market operates 24/5. If you missed one big move today, there will be more tomorrow. Embracing this mindset reduces the fear that drives FOMO trades. Stick to your strategy criteria. Make it a rule that you only take trades which meet your predefined criteria. If a move is happening, but you have no setup for it, let it pass. This is easier said than done, but disciplined traders prosper in the long run. If needed, step away from the screen for a bit when you feel the itch to chase a runaway market. Use the cheetah analogy. A helpful analogy is to think like a cheetah on a hunt. The fastest animal doesn't chase every gazelle it sees. It waits patiently for the right moment, the vulnerable prey, to pounce with high probability of success. Likewise, as a trader, wait for high probability setups instead of trying to jump into every sharp move. This mindset shift can save you from many losing trades. By avoiding the trap of chasing the market, you maintain control over your trading decisions. Trade based on strategy, not fear. If you feel that pang of FOMO, take a deep breath, remind yourself of your plan, and remember that the Forex market isn't going anywhere. Opportunities are like buses. Another one will come along soon. Few things are more damaging to a trading account than revenge trading. This mistake happens when a trader experiences a loss or a series of losses, and, out of anger or frustration, immediately tries to win it all back with impulsive new trades. In revenge mode, you abandon your strategy and trade emotionally, often increasing position sizes or taking random high-risk setups to recoup the loss quickly. It's akin to a gambler going on tilt, doubling bets after a loss, which usually leads to even bigger losses. Why this is a problem? Revenge trading is driven by emotions, primarily anger, ego, and the desperation to not accept a loss. Instead of cutting losses and sticking to the plan, a revenge trader might double down on the next trade or take a new position without analysis, hoping to get back to break even. This often compounds the damage. You can end up in a vicious cycle. The more you lose, the more you try to retaliate against the market, and the more you lose. Moreover, trading in an emotional state clouds your judgment. You'll likely violate your risk management rules, e.g., taking a far larger trade than usual or removing stops, because the focus is on recovering money rather than executing good trades. The end result is nearly always a much larger loss and a bruised trading account and psyche. How to avoid it? Acknowledge and accept the loss. The first step is psychological. Remind yourself that losses are a normal part of trading. Even the best traders take losses. Accepting a loss calmly is crucial. If you catch yourself feeling the sting of a big loss and the urge to immediately trade again, pause. Tell yourself, okay, that hurt, but trying to force a win right after will likely hurt more. Sometimes you have to take a step back and swallow your pride. The market is not out to get you personally. You just had a trade that didn't work out. It's done. Take a timeout. One of the best ways to prevent revenge trading is to remove the temptation altogether when emotions run high. Step away from your trading platform for a while. Close your trading software. Yes, log out of MT4/MT5 or shut down your computer and do something else to cool off. Go for a walk, stretch, grab a coffee, or anything that relaxes you. This break allows your emotional temperature to come down. Many traders institute a rule. After a loss exceeding a certain amount, they will stop trading for the rest of the day or at least for an hour. This cooling off period can save you from making rash decisions. Set daily loss limits. A practical technique is to decide on a maximum loss per day or per week that, if hit, you will stop trading for that period. For example, you might set a rule to stop if you lose 3% of your account in a day. Most trading platforms won't enforce this for you, though some broker risk management tools or plugins exist, so it's on you to be disciplined. By having a hard stop for the day, you prevent a bad day from turning into a terrible one via revenge trades. Refocus on your plan. When you feel the revenge impulse, force yourself to review your trading plan or journal. Remind yourself of your strategy's edge and your long-term goals. Think of it this way. If your strategy is sound, one loss is just a part of the statistical outcome. There's no need to deviate. If the loss came from a mistake, identify it and note it down. Channel that energy into learning, not trying to immediately earn the money back. Reduce position size after a loss. If you insist on continuing to trade the same day after a loss, consider cutting your position size down significantly. This might feel counterintuitive since you lost money, why trade smaller? But it helps break the revenge mindset. By trading smaller, you signal to yourself that you're in control and sticking to discipline. It can prevent a spiral of ever larger bets. Learn from every loss. Instead of seeking revenge on the market, seek knowledge. Analyze the losing trade. Was it due to market unpredictability, or did you violate your rules? If you made a mistake, what can you change to avoid it next time? If not, then sometimes the market just didn't favor that trade, which is okay. Every loss carries a lesson. By focusing on improvement, you turn a negative into a positive. In summary, don't try to fight the market after a loss. You'll only hurt yourself. The market doesn't know or care that you're down $500 and need to win it back. Stay calm and trade on with your plan when you're ready. By avoiding revenge trading, you preserve both your capital and your confidence. As the Warrior Trading Team puts it, unchecked emotions can lead even a smart trader to up their position size, stay too long in a bad trade, or see false patterns. Essentially, to trade poorly. So keep your cool. If you lose one battle, step back, regroup, and come back to fight another day with a clear head. In Forex and any market, more is not always better. Overtrading refers to taking too many trades, whether in frequency or volume, often without proper justification. Traders might overtrade out of excitement after a winning streak, feeling invincible, out of frustration, trying to compensate for losses related to revenge trading, or simply out of boredom, feeling the need to always be doing something. Modern trading platforms make it as easy as a click to execute a trade, which is convenient but also dangerous if you lack self-control. Why this is a problem? Overtrading typically leads to a decline in trade quality. When you take numerous trades, you are likely venturing beyond the high probability setups and dipping into mediocre or poor trades. It also racks up transaction costs. Spreads or commissions can eat into your profits when trading frequently, especially for small gains. Furthermore, excessive trading can cause emotional fatigue. The mental focus required to trade well is a finite resource each day. If you overtrade, you may find yourself making mistakes or risky decisions due to tiredness or stress. Another aspect is risk exposure. The more trades you have open or the more often you trade, the higher the chance of hitting a losing streak or encountering adverse market events. Think of overtrading as quality versus quantity. A few well-chosen trades often outperform a scattergun approach of many random trades. How to avoid it? Set a trade limit. Decide on a maximum number of trades per day or per week and stick to it. For example, you might limit yourself to 3 trades a day. This rule forces you to be selective. If you know you only have a few bullets to fire, you'll choose your shots more carefully. Some traders also set rules like, if I have X losing trades in a row, I'm done for the day to prevent a cascade of trades. Focus on high probability setups. Quality over quantity is the mantra. Develop criteria for what constitutes an A-grade trade setup for you. Could be a confluence of signals, a certain risk-reward ratio, etc. Commit to trading only those scenarios. It's better to take one solid trade than 5 flimsy ones. By waiting for clear signals that fit your strategy, you automatically cut down on impulse trades. Remember the cheetah analogy from earlier. Wait for the prey that's worth the chase. Don't run after everything that moves. Use a trading journal to identify overtrading. Keep noting your trades and reasons. If you notice in your journal that you took some trades out of boredom or without a solid reason, highlight those. Over time, this will make you more aware of your impulses. For instance, your journal might reveal that after 2 p.m., you tend to place extra trades with no setup, perhaps due to boredom in a slow market. With this insight, you could set a rule to avoid trading during certain low volatility hours, or to only trade a set number of hours a day. Reviewing your log can shine a light on patterns of overtrading. Maintain discipline with technology. The very tools that enable overtrading can also help prevent it. Some trading platforms allow you to turn off one-click trading or require a confirmation for each trade. Keeping that on can give you a second to reconsider before you fire off another trade. There are also trading journal software or plugins that issue warnings if you exceed certain parameters. Even a simple timer could help, e.g., wait at least 15 minutes between closing one trade and opening a new one to force yourself to reassess calmly. Have a trading routine. Structure can curb overtrading. Decide in advance. What times of day will you trade? How many setups will you look for? When will you not trade? Perhaps during low liquidity times, or after a big news event until things settle. A routine can prevent the feeling of, I should be trading right now, when in fact there's no valid opportunity. If you find yourself trading out of habit or boredom, it might be time to step away and take a break, just as with revenge trading. Overtrading is often a silent account killer. It might not blow your account in one trade, but it can slowly bleed it through accumulated small losses and fees. By being patient and selective, you not only protect your capital, but also reduce stress. Remember, you don't get extra points for trading more, you get rewarded for trading smart. As the saying in trading goes, you get paid to wait. Sometimes doing nothing is the best move. Every trader makes mistakes. It's part of the learning curve. The goal is not to be perfect, but to recognize and minimize these common Forex trading mistakes before they wreak havoc on your account. We've covered how errors like trading without a plan, poor risk management, overleveraging, ignoring stop losses, chasing the market, revenge trading, and overtrading can seriously undermine your success. The good news is that all of these mistakes are avoidable with the right habits and mindset. By focusing on proper discipline, preparation, and risk control, you can turn these potential pitfalls into opportunities to improve. Always remember, trading is a marathon, not a sprint. Avoiding mistakes doesn't mean you'll never have losing trades. Losses are a normal part of the journey. The difference between a losing trader and a winning trader often comes down to managing those losses and learning from mistakes rather than repeating them. Control your risk, follow a well-structured plan, and keep your emotions in check. In time, you'll build the consistency and confidence that set successful traders apart. Now, over to you. If you found these tips helpful, please like this post/video and subscribe for more insights on Forex trading. Have you encountered any of these mistakes in your own trading? How did you overcome them? Leave a comment below with your experiences or any questions. I'd love to hear your thoughts and help each other grow as traders. Remember to trade smart, stay disciplined, and until next time, happy trading.